everyone. Thank you for joining WisdomTree's office hours on Will the Fed be able to shake it off and cut rates later this year? Where you'll hear from Professor Jeremy Siegel, WisdomTree's senior economist, Jeremy Schwartz, our global chief investment officer, and Kevin Flanagan, our head of fixed income strategy.
Well, the markets certainly like today's data. We'll get the professor's take. We'll see if the markets are shaking off some of what Powell said and what the professor, his view on it. Kevin, it's always great to be on with you on these post-Fed, post-inflation days. Professor, I know we've got our own numbers on inflation. You've got some interesting takes on all this happening. So get right to it. Give our listeners some of your view of what's happening, what Powell said.
Yeah, well, first of all, I thought it was a really good report. I thought it was a better report than the details. And one of the major reasons is that we got below expectations, despite the fact that the distorted rental component stayed at 0.4% as it has for, I think, about 4 consecutive months. Powell made reference to it a lot. It took him 3 years to get it. If you've been listening to us, we got it right away, but the Fed didn't. But he does now. He realized how lagged that actually is. And in fact, Gunlack, who was on CNBC right after commenting, he's been talking about it too. And in fact, he pointed out, basically, if you use real shelter data like apartment list, basically you're well below 2 on a year-over-year inflation number over here. So, and as Powell said, you're going to get that filter in. We just don't know when. We all thought it was going to filter in much earlier, but the way it's constructed, it's filtering in low. All right. So nonetheless, I thought it was maybe a little bit of an overreaction when the 10-year went from 442 down to 426, and then kept on going down until 2 o'clock. Now let's talk about the number of cuts. The Fed has absolutely zero idea how many cuts they're going to make. It's almost like how many of these members think it's going to snow on December 31st? And sometimes it's 13 or 14 and sometimes 11 or 12. They don't know. They absolutely don't. And in fact, if you listen closely to Powell, he used the word data dependent more often than any other thing. It just depends on the data. It just depends on the data. And it does just depend on, look at how things have changed. Now, let me say something else. Which I think is a little misunderstanding. Everyone had to put their projections of how many cuts they thought was going to make before the meeting, about 3 or 4 days. He gave everybody the opportunity to change their meeting as a result of this morning's data. Now, his comment was, a few did, most did not. Now, you got to be careful. Most did not because they didn't think that the data changed their forecast? No, not really. If you understand how people work, people say, yeah, I might have changed it, but I'm not changing it. Going through all that process, et cetera, and so on. And in fact, he made a comment. He said it was really close in the discussion. A lot of people put 1 or 2, said I'm right in between. And okay, you got to pick one. All right, so shoot a dart and pick one. I bet if you actually took a poll right now, you would have more in the 2 cuts than you would in the 1 cut. But again, does that make any difference? No, because it all really depends on the data. Now, what we're saying is we think the data is going to be coming in good on the inflation front. Now, it is true the long bond has given up almost half of that pretty mammoth gain that it made before. On the stock side, we go back to the theme that, it's sort of a mixed theme. I've been saying there's nothing that I see yet break the momentum of growth over value. And to take a, you take a look today, and you take a look at Nvidia, and you take a look at Apple. Boy, that's a little bit puzzling, given Cook really didn't say anything new. Is it buybacks? Is whatever it is that's bringing that up? And then, of course, you have Kathy Woods, who hasn't been right in the last 3 years. Say Tesla's going to 2,500 or something like that, or whatever price. And Tesla's up 4%. So Mag 7's up 2%. However, what I did note, which I think is quite sensible, was Russell 2000. It was up 1.7. It was actually up 2.5 during the session. Now, small stocks are going to benefit from lower rates. Now, I really said the lower rates, which will be brought on by lower inflation and somewhat of a slowing of the job market, is really going to help the smaller stocks. Even though it might mean a softening of the economy, they're priced basically for a mild recession, and they need those lower rates on the turnover. So that part was pretty good. But this was a definitely good report. Now, PPI tomorrow will finish it off and give us the PCE already. I think Goldman Sachs has lowered its PCE by 1/10 on expectation, just on the basis of CPI data, which is unusual. They don't usually do that because they wait for the PPI data actually to come through. But this is definitely looking good. Now, what's also looking good is take a look at the commodity market, still down. I mean, take a look at energy prices are lower. We're lower in May than they were in April. That caused a zero increase. Well, take a look at the average gasoline price. We're approaching the week. Next week is the week they take the prices for June. We reported in July. But take a look at the average national gasoline price now compared to the week they took it in June. Excuse me, in May for the June that was just reported this morning. Much lower. We could get another zero. We could even get a minus 0.1 going forward. This is remarkable on that score. Again, and if you finally have the rental part of it kicking in, well, that's going to be just double good stuff that's coming. Things could always change. There's a little bounce back in oil from the lower prices that we had seen before the labor market report a week ago. But, basically, the commodity prices are off their highs. And that's what's really quite favorable. And the momentum is still there, and there's nothing really breaking the basic bull market and the basic bull market in growth stocks. I mean, you need multiple, disappointments on that score to break that particular strong trend. Now, it doesn't mean value stocks won't go up, and they've been holding their own, and some sections have been doing quite well. But right now, Nvidia, Apple, Microsoft, that nothing's breaking those trends just yet. And earnings estimates are still doing very well going forward. So, in summary, I mean, obviously, if you take a look at the relative reaction of the market to the CPI this morning relative to the actual dot plot, which was announced at 2 o'clock, the magnitude of the bond market move and the stock market move was like 5 times more. What did they think was more important? And it was the CPI coming in as mild as it is, no matter what the Fed says. Again, the Fed can say anything it wants, but it will be basically following the data. I thought Powell was very flexible. I thought he was right on. I think he finally gets it. I mean, the only thing I fear is that if we get some weakness, that he'll spend too much time teeing it up. Now, the next meeting is July 31st, which is a non-dot plot meeting. If we can get another good CPI in July, let's say unemployment ticks up 4.1, and we get with that, I think he'll tee up a cut for the September, 12th meeting, if I get that one right. But that depends on a lot of data. That's 6 weeks away, 7 weeks away. So there's a lot of data goes down before that sort of thing. But it's not impossible. So the only danger is that, again, by the way, another unanimous meeting. There is only been, I think, for how many consecutive meetings has this been? I think it's one short of the all-time record that was set during the Greenspan era of how many meetings there has been without a dissent. So if there was another meeting in July without tie the record, another meeting in September will break the record. But that's pretty much the way Powell, and that's what Powell says. Powell goes around to every FOMC member and says, this is what we're thinking. How do you think? How do you think about what we think or what I think? How can we incorporate your concerns into the statement that would make you go along with the statement? Well, once someone approaches you like that, you're not dissenting unless you've got real strong feelings. And that's his approach, for good or bad. He's getting unanimous calls on each. I mean, this was a pretty no-brainer. This shouldn't have been a close one anyways. But there'll be some closer ones coming up. If we see inflation go down, or weakening of the economy, you might bring about the first dissent somewhere down the line in 2024. With that, Kevin, do you have anything you want to add? And then we could go to questions.
No, I think you covered it all, Professor, but it did, I think, prove to be a great segue into a couple of questions we've got. Powell did talk about not wanting to break things and fix things. I saw come across the tape there, and we got a couple of questions coming in. Do you think the Fed's going to be too late, like they were on the rate hike side? Are they going to be too late on the rate cut side?
It's possible because of his teeing up. That he doesn't, so I'm not surprising the market. Well, you got to get consensus. He likes to tee it up at one meeting and then do it the next. Well, if it takes you 2 meetings and data, you're already 3 months behind the ball. It's a danger, that he could be too late to cut if things really turn soft. He's willing to, but might be a little bit too late. So what does that mean? It means we might get a little bit more softness than we should get. Now, I will say also, looking at the money supply, I was encouraged, in April and May to see some bounce in deposits. That's kind of petered out. We're not going down, but we're not going up. And in fact, total bank deposits have only risen so far this year at about 1.5% or so, which halfway through the year is really not enough to support a 2.5% growing economy and 2.5% inflation. Now, that's a loose relationship year to year. That doesn't worry. The good news, we're not going down anymore as we did for the 2-year period between March 2022 and March 2024. March 2022 and March 2023. Then we stabilized. We went up a little bit on a hump. But then the only way to get the money supply moving is lower rates, right? And so you increase the ability of people to take out loans, et cetera, and so on. There was a report. Someone did a report that if every small bank marked to market their commercial bank loan holdings, they would be insolvent, and the number was in the hundreds and hundreds of such banks. They're just rolling it, rolling it and hoping. We need consolidation in that area. It's not a banking crisis. It's not anything that, is a real big downer, but it shows you, where those are trouble areas. So if we get into those trouble areas, the Fed has to move quickly enough. There is a danger that he will move too slow. He knows where to move and how to move. He doesn't have the ideological resistance to the fictitious narrative that these were, 4 years ago, that the inflation was temporary. He doesn't have any fictitious narratives now, which is a good thing. But is he capable of moving fast enough if he sees softness is just yet to be seen.
There are a few questions on how the election timing comes with that. You mentioned the tee up, maybe the Jackson Hole conference in late August is another place he could tee up the cut in September. But are you getting too late for September? They start cutting with the election right around the corner.
It's my feeling that Powell will do what he feels he has to do no matter what the election schedule is. He's going to step on some fingers. Some people are going to say it's political. Fine. Powell doesn't need this job. He can make 50 times as much by quitting. And if not much more than that, and probably will after he leaves. So, I mean, he doesn't. I honestly think he's going to do what's right. I mean, if we see a weakening, really on the unemployment side, and or the inflation side, the best news for stock market is not much weakening at all on the employment side, and that inflation going down. Then the other thing is weakening on the employment side and weakening on the inflation side and drops. That'd be more neutral for the market, and then less good for the market would be weakening on and the drops are not fast enough. Again, I don't think that would cause any bear market or recession. Could cause a correction. It's way too early to make that call. But let me get to the bottom line. I think Powell is the type who will do what he thinks is right, even if it is a September meeting, 2 months before the election.
I think that's a great answer, Professor. I've been getting that question a lot as well. I was doing a client lunch out in Chicago, and the closer we get, right, I think more and more people are going to be asking that question. I think another one that I think is interesting is, and Powell touched upon it somewhat today, the labor market data. There's been a kind of a disconnect between the payroll and the household survey of late. And I was just wondering if you could give us our thoughts on that. Do you think non-farm payrolls are being overstated in terms of job growth?
There's some sign that they're being overstated by some, but not by a lot. There's been some studies. And by the way, month to month, I've seen huge disconnects between where household goes up and payroll goes down, or vice versa, like what we had last Friday. It really is. I mean, one is a much broader survey. It's a different survey. It asks different questions. You have part-time workers. You have other workers. Yes, I do think there's more softness than the 200 and some thousand increase that we saw in that payroll. And I think Powell recognizes that. So we could see part of that to be a reversal, another reason to tee up a cut. Could he, and by the way, he has that. So August is Jackson Hole. July 31st will be the meeting. If the data keeps on going by the middle of August or toward the end of August, then he can reinforce that. kind of tee it up, reinforce it, and do it. And he might do 50. If things weaken, he could do 50, could do 75 after all. How many? We did 3 or 4 75 base point jumps. That would be pretty unprecedented. Actually, I'd get worried about that because to 75, that means things are really weakening. It wouldn't be inflation alone that would bring about a 75 basis point cut. It'd be a big weakening of the labor market. So I wouldn't hope for that. That would basically mean bad news. But he should do it if that news happens. If there is a big weakening in the labor market, he should lower 75. I mean, I think neutral is now. By the way, the long run, our star went up. For years the Fed thought it was 2.5%. Our star would be 4.5% Fed funds. Then it kept on going down and down and down to where they thought it was 0.5%. I actually thought it was 0 or negative. Then in March they raised it to 0.6. Today they raised it to 0.8. But they haven't really discussed it. It's my feeling it's between 1 and 1.5 right now, which could give you a neutral Fed funds rate of 3 to 3.5, which is 200 basis points under the current Fed funds rate of 5.33%. So there's still a lot of, to get to even neutrality. By the way, no one brought out this sort of consistency. The Fed thinks it's going to reach the 2% CPI or its PCE target. Let me just check the data here. Yeah. By the end of 2026, core PCE inflation and PCE inflation are reaching 2%. Well, then why is the Fed funds rate at 3.1? That's when it should be back at 2.8, the long run rate. That's sort of an inconsistency there. So really, the truth is that they really think that our star has gone up even more than what they indicated. They probably think it's 3.1. I think it's probably closer to 3.5 on what it should be. But that's still 200 basis points lower. And that's what the Fed should be moving towards. And rapidly if there's any weakening of the labor market.
Let's zoom. A few of the questions came in, and maybe we could zoom out for some of these questions. So Joe asked a question about what's the biggest issue that could derail us over the next decade? So we're not just thinking about next 10 days, but sort of looking ahead. And another, Todd asked a related question, as it seems like we're ignoring a lot of sort of bad news, what ifs, geopolitics, narrow leadership, valuations, VIX. Any connection between those kind of questions as for your outlook over the long term?
There's always risks, and there's always geopolitical risks. I don't see them being unusually high at the present time, very honestly. The Middle East is what it is. I don't see that. I think there seems to be less risk to me in the Middle East. One of the reasons oil is down than there was 3 months ago, 6 months ago. I'm not saying we're at a solution. I'm not saying it has potential of not boiling up. It's boiled up for 100 years, and all that. But I don't see geopolitical risks as being unusually high compared to history or even, the last 20 years. In terms of other risks, I've mentioned many times that I don't think the deficit is a current risk. I don't see that as a risk over the next 5 years. I'm preparing some data and slides that I think support my position there. I haven't finished those yet. I don't think the debt is a big risk. I told you that I thought that the biggest risk actually is a cyber attack of major proportions that affects our entire financial system, and maybe other parts of governmental systems. I'm not saying that's high, but I think that is a risk that we should be guarding against.
I think another interesting point, and I think Morgan asked this question, Professor. Here we are talking about 1 rate cut, 2 rate cuts, and the question is, Does really a quarter point or 2 quarter point rate cuts make that much of a difference?
No, but it tells a direction. I mean, are we headed towards something? Once they start it starts the procedure. And it's on going down. Now, I think, but it's not going to go down to, well, they say 2.8. So I think you have to think about 3.5. And if you're floating 2-3 points above LIBOR, well, now it's called SOFR, the secured overnight funding rate rather than LIBOR. But let's say SOFR. I mean, Gunlock basically talked about that, and he's been touting these B-rated bonds now for a long time. You're talking about 200 basis point drop, and you have to ask yourself, for a lot of these loans, is a 200 basis point drop making them solvent or not on the commercial real estate side? 200 basis point drop on, when you're prime plus 8 on like credit card, doesn't matter, 200 basis points. Mortgage rates matter. Now, mortgage rates right now, a 0 point, what do I see here for today? A 30-year mortgage is 7.28, 7.25. Oftentimes, by the way, you see 6.75, 6.5. That's usually with points. So I'm saying here on the 0 point market, 7.25. That'll go down when the Fed goes down. Now, even though I don't think the 10-year will go down much, but don't forget the duration of a mortgage is much lower than the bond, because all the payment of the bond is at the end except for the coupons. Well, there's equal payment for the mortgage. So a lower short-term rate and a more normal term structure will probably bring that mortgage rate down, 100 basis points, 125. But, we're not going to the 3%, 30-year mortgages that we had during the early days of the pandemic. And those days are over.
One of the questions comes on, you talked about the valuation, nothing stopping growth over value. Some questions on the AI frenzy, how much substance to the economy. I know people ask you a lot, are we in the tech of 2000 days? And you talk about that a little bit. But
yeah, I mean, I'm not an expert on that. I don't know. People, all of a sudden, there was, GPT, and now there's all these rivals. I think that's good for the world economy, that there's these rival large language intelligence programs. The question is, are they going to be commoditized? Now, the truth of the matter is that doesn't really affect NVIDIA if they're in the leader of providing them, because that race will go on and it'll make profits. But how much will the other companies be able to make profits if they compete each other? If everyone has their AI model, they're going to be competing with each other, and the question is, how much profit can they squeeze out of it? Now, of course, you're wedded. Apple has the name brand and all the rest, and if they, obviously people will maybe only the new phones will be able to get the AI built in there, and then people will be much more motivated to upgrade their cycle much earlier than they would otherwise. I think that's part of the thinking here. But outside of that, it could be a big thing for productivity, but it may not be as big a profit center for the tech companies in terms of getting money for their AI models if there is a lot of competition. But we'll have to see how that shakes out. I still think AI is amazing. I still think AI is going to increase growth and going to allow a lot of companies to do things a lot cheaper and increase their margin profits.
I think an interesting question, Professor, just came in. For someone that allocated to bonds back in November of last year, so that's right when we were just coming off the peak in rates, is there capital growth beyond a 4.75% average coupon rate? That's a question we get a lot. With rates being here, the offset stocks and bonds, have rates risen to the point where you could see perhaps reallocations occur?
Well, I earlier in the year I said my long-term bond was 4.5. I've sort of extended that. I'd say, I can't go with a fifth. Long term, I'm going to make it 100 basis points, 4 to 5. I think we're in the range of the long run rate. So you're going to get 4 to 5, and you 2.5% inflation, 4 to 5 is not really exciting in terms of real return. The tips, the 10-year tips right now is 2.08. So it's a 2% real return, while stocks are priced at least 5. So percent real return. So there's the differential. I think long-term bonds are within their range. Of course, normal volatility will bring them out of their range from all sorts of circumstances. But I see that as a long-term, tendency for the long bond.
One question coming back to sort of the monetary policy element is, has the transmission mechanism broken down? We've been high for long. Is it that we're just not as restrictive as we thought? Is just taking longer? Any other views on the transmission mechanism?
Well, no, I think the transition is there. What's happened is that the neutral rate has gone up a lot. We're not as restrictive as we thought. When our star was 0.5% or 0, then 5 1/3 is really restrictive. But because of a number of factors that I've enumerated, namely, the fact that inflation risks are there, raises our star, the fact that faster potential growth in the future raises our star, it means that 5 1/3%, which is where we're at right now, is just not as restrictive. It is still restrictive. That's what Powell said today. It's still restrictive. There's no one. I mean, the maximum. If you take a look at the dot plot, the maximum long run is 3.75. So we're 1.5% above the highest FOMC estimate of what the long term is. That's restrictive. So we are in a restrictive mode. Why it's taking longer is that we are not as restrictive as we used to be. When our star was 0, that was super restrictive. When our star is 2, or 1.5, then you're just not as restrictive. It takes longer. Well, basically what's happened, is that so much of the economy and the tech sector is so strong, and certain parts of the service sector are so strong, and healthcare employment continues to be so strong as the aging in society. All those are sort of continuing to plow ahead, and those sectors that don't get that growth, like real estate and selected real estate sectors, and particularly commercial real estate, get to unfortunately suffer. So everyone else says, "Hey, I'm doing well despite these high rates." Well, there's others that can't keep up. They're dragging that high real rate along, and the economy, the Fed has to react. But no, nothing has changed. What has changed is the real rate is not constant. Our star is not constant. It moves around. It just has gone up. But I don't see anything broken, really, about monetary policy.
So last question from me, Professor, and I think this is a good one. Saving maybe the best for last. A question about the yield curve inversion. We've been inverted for quite some time now. Is this going to go down as a period of yield curve inversion where it did not predict a recession, or do you think a recession is still out there somewhere looming ahead the next 6, 12, 18 months?
Possible, but less than 50-50 probability. I mean, I think one of the things that's different is that and actually, you know, we've had some Fed members actually talk about it also, is the fact that inflationary expectations never got out of hand during the inflationary episode that we had. That's a big situation that really causes an inflation when you're trying a recession when you're trying to bring down inflation. And Austin Goolsbee had a big seminar, and you know he's the Chicago Fed guy from the University of Chicago and Chicago Fed guy. He's given some seminars on this issue, and it's something I pointed out also. So I would say it's not impossible. I mean, it would be 60 years that we haven't had a recession following an inversion, but it doesn't mean that it's impossible because of the unique qualities of the inflation and the recession that the COVID pandemic caused.
Well, Professor Kevin, it's always great doing these market calls with you all. Thank you for joining us once again. There's a number of questions on portfolio implications and others that we can follow up with people individually on, things like alternatives and the role of gold, the role of the dollar in portfolios. We do a lot of publishing on all these topics. So we'll follow up with some of you individually. But Professor, always great to be on with you. Kevin, thanks so much for doing it. And we'll talk again.
We'll talk to you soon. You keep in touch. We, as you know, we have weekly podcasts every Friday, and we publish them on Monday.
Behind the Markets for staying in touch with our weekly views. And of course, you go to our strategies page. You get the professor's commentary every week from there, as well as a lot of other great dashboards and insights. So stay tuned for that, and let us know how we can help. Thank you so much for dialing in today.
Take care, everybody.
Thank you. Yeah, good weekend.